Hello, I'm Tanya Hamilton with Urban Haven Group, and today we're here with Ryan Iannone at Mortgage Connection, and he's going to talk about what happens when big banks say no and you need to get alternative lending.
Hi.
Did I
You want me
pronounce
to
your
take
last
over?
name properly?
It's Iannone. That's okay. You were close.
Iannone.
Yeah,
Sorry about
it's one of
that.
those easy ones.
Right?
Okay. Well, yeah. Thanks for having me. So I'm going to jump into alternative lending. So have a discussion about what alternative lending is, how it is used, how we use it, um, how alternative lending is different from what we call prime lending or bank lending, private lending, all that other stuff. So we'll jump right into it. So once again, my name is Ryan Iannone. I'm a partner mortgage broker with your mortgage guru team over at Mortgage Connection. I've been in the industry for almost 23 years. It's been basically my job, my entire working career. So been doing this for a long time, have seen lots of different economies. One thing that has been prevalent through the whole thing is alternative lending. It became very popular around 2005, 2004, and it's been one of the fastest growing products out there. And you'll probably see why once we jump into it. And I just want to thank you guys for having me on here. I appreciate it. Always good to get our info out there so that people get a little bit of education on what's available to them. And this is something that a lot of people don't understand. And honestly, if you go into your bank and you talk about alternative lending, your bank's going to think you're crazy and tell you to go somewhere else because they don't do it. So good with me just to jump into it, start going through?
Yeah, you bet.
Okay, perfect. Okay, so alternative lending. So basically when the banks say no. So what is alternative lending? So these are lenders that typically work with mortgagors who do not qualify for prime lenders. So your prime lenders are going to be your big banks, any kind of AAA lending, any kind of insured lending. So when you're putting 5% down and you're doing a CMHC mortgage, or basically who's offering the best, lowest rates. The easiest way I can explain an alternative lender is if you put lenders on a line, on the one side, you've got your big banks. On the other side, you've got private lenders, so the highest risk lending. And then in the middle, we've got what we call our alternative lenders. The big banks, cheapest money, or I shouldn't say the big banks, prime lenders, cheapest money, hardest to get qualified for. Private lenders on the far side, most expensive money, but the easiest to qualify for. Alternative lenders fall right in the middle. So they are the lenders that are making it a little bit easier for you to qualify, but it's still not the easiest, and their rates are kind of in the middle of the private and the prime lending. So there are kind of four very specific ways and reasons why we use alternative lenders. And I'll go through each of them in a little bit of detail, but basically here's the four. So buyers who are self-employed, but have been self-employed less than 2 years, or as a self-employed person, they're not claiming enough income on their personal income taxes to qualify for a prime mortgage. So that's one thing we use them for. Anybody that has bad or bruised credit. So if you currently have a lower credit score because you have a couple of missed payments or a couple of late payments, or all the way up to people that are, in bankruptcy, in consumer proposal, anything like that. So these guys will look at those situations. Someone that wants to get a higher mortgage than they qualify for. So someone comes to us and says, I want to get a mortgage for 500. The prime guys will only do 400. Maybe we can get it done at 500 with an alternative lender. And then the last one, probably the least used, but another reason why we'd use an alternative lender is for investors with bigger portfolios. So they have lots of properties in their portfolio.
I have a quick question.
Yes.
Now, would that be the same as someone who's considered a high net worth individual, or are those two things different?
It could be. So when I say an investor with a big portfolio, we're talking like people that have, and I'll get into more detail in it later, just have lots of properties.
Mm-hmm.
So the prime lenders are making it tougher for those guys to buy more. Mm-hmm. The alternative lenders are doing those people, getting those people mortgages a little bit easier. High net worth clients can fall into this world. We have done mortgages for people that were worth millions of dollars who were self-employed, and on their personal income taxes, they claimed very little money, but they wanted a big house. So we were able to use these types of lenders for those people. And then on the prime side, once again, for a very high net worth person, we do have programs for them through the prime lenders as well.
Cool.
Okay. So who are alternative lenders? So there's a few lenders that are banks and only offer alternative products. So Home Trust and Equitable Bank, if you go to either of them, they are considered your Schedule I banks, just like RBC and Scotia and those guys. On the mortgage side, they only do alternative lending. Both of them have tried the prime side, didn't like it. So both of those lenders only do alternative lending. Community Trust is another one that's out there that only does alternative lending, and Haven Tree. So these are all lenders that only do alternative lending. You can't go to them and have options. You can only do alternative lending with them. And then most alternative lenders that we deal with are, they offer multiple products. So here's some examples. So all these most of these lenders, the First Nationals, MCAP, Strive, CMLS, if you've never heard of them, what they are called are Schedule II banks. So they are financial institutions in Canada that don't have their full banking license. They can't do deposits, they can't do RSPs, they can't do investments and stuff like that. But what they can do is lend on mortgages. So they have an A side or a prime side. So First National is the largest, what we call monoline or non-bank lender in Canada doing prime mortgages. But they also have a division called Excalibur, and that's alternative lending. Eclipse is MCAP, Aspire is Strive, Avio is CMLS. So the left side is their alternative division, and the right side is the main company. Canadian Western Bank is a bank, but they also have Optimum, which is their B side or their subprime side. So there's a couple of other lenders like similar to this that have a prime side and an alternative side, and they're lending out on basically anybody except for the private side. So there's lots of options with these types of lenders. They all, when it comes to alternative lending, so they all have very general guidelines that they have to follow. Now, the biggest one is probably going to be the 20% down payment. They do require 20% down payment because by law in Canada, if you are a financial institution that is lending on mortgages, if someone is putting less than 20% down, you have to have an insured mortgage. So if you put 19% down or 5% down, and the lender you go to is a financial institution in Canada, they have to get that insured. Alternative lender mortgages are not insured mortgages. They don't follow the guidelines of insurers. So for them to be able to work in the way that they do, you have to have 20% down. So that's a big one, a minimum of 20% down, I should say. Another important part of them is the property. So when they are lending on higher risk people, so they're making exceptions on income, the credit's maybe not as good, all of that stuff, when they're making those exceptions, that property becomes more important. So they're really looking at the type of property that you are buying. They're looking for mainly properties that are in big urban centers. They're not really big fans for the most part of rural areas. So if someone does want to buy a rural property, you might have to put a much bigger down payment to limit their risk. But what they love to see is single family detached home or semi-detached homes in big city centers. So they're looking for in Calgary, Okotoks, Airdrie, Edmonton. That's kind of their bread and butter. They will get outside of those areas at times, but they're looking for really strong deals if you're not in a major center. They also do not look like properties that are unique in the words if you have something that is what did I have one time? There was a property that was built into the side of a hill kind of thing. So very, very, very unique type of property. It was beautiful, but for them, the risk of that property. So they always look at if we end up back with this home. So if these people default on this mortgage and we own this property, how quickly are we going to sell it and how easily are we going to get our money back? And unique properties are going to have a much smaller buyer base than a regular semi-detached home in a city. So property is a big one. They don't really like, most of them really don't like, apartment style condos, smaller apartment style condos. They will do them by exception for a strong deal, but for the most part, they're looking for semi-detached or detached homes. Yes.
Yeah, and how often than not do you find that alternative lenders require the buyer to also get an appraisal in those deals?
So for the most part, I'm going to say that alternative lenders are probably 80 to 90% you have to get an appraisal. Just because because the property is so important to them, they will require, in most cases, an appraisal. A couple of them do have online appraisal systems, just like the prime lenders do. So some of those lenders that are prime lenders and alternative lenders, they use the same online appraisal system. If it passes, they're okay. If it doesn't, they need an appraisal. But I would say the likelihood of an appraisal for an alternative deal versus a prime deal is considerably different. Way, way, way more likely for an alternative deal. Okay.
Thanks.
You're welcome. All right, so those are the general guidelines. So now I'm going to get a little bit more detailed into the main reasons why we use these lenders. So one of the biggest ones is going to be self-employed. So when you apply for a mortgage through a prime lender as a self-employed borrower, so self-employed borrowers are going to be anybody that is basically taking an income and is responsible for paying their own taxes. So whether you're a sole proprietor, a partner, or you own an incorporated company by yourself or with people, or you are a contractor. So if you get a contract with a company, they are paying you directly, then you are either doing your taxes as a sole proprietor or as a incorporated company, you are considered self-employed. So the standard guidelines for a self-employed person for income, I'm self-employed, Tanya's self-employed. The general guideline is you need to have 2 years of personal income taxes as a self-employed person. So once again, whether you're incorporated, a sole proprietor, or whatever you are, basically what we have to do is get 2 years of your personal income taxes, and we need to show what you are claiming personally and paying income tax on personally. So if your company makes $200,000, that's great. The prime lenders don't really care. What they want to see is your T1 general. You take that $200,000, you have all your write-offs, all the things that you can do with your taxes, and you claim $50,000 personally. That is the income we're doing. Okay, so they really take your income and beat it down to what you are paying personal income taxes on. So it can be pretty tough, and we need those full 2 years to do an average of them. We do not use like I said, we do not use the business income. We use the personal income, and they only use what you are paying your personal income taxes on. With alternative lenders, you just need to be self-employed for a minimum of 6 months. So the big difference between 2 years and 6 months. So someone that is newly self-employed, they want to buy a house. We don't have to wait for those 2 years. We don't have to get 2 years of personal income taxes. We just need a minimum of 6 months. Sometimes 12 months, depending on the business, but a minimum of 6, we can at least have a discussion. Basically, the way that we get around this is we can use 6 to 12 months of your business bank statements and calculate an income using deposits minus any regular expenses. So someone comes to us and they've said, I'm going to use Tanya as an example, comes to us and says, I've been a realtor for 14 months. Okay. So what we're going to do is we're going to, if you're an incorporated realtor, what we're going to do is we're going to get your business bank statements for 12 months. We're going to go through and look at all of the deposits, all the revenue that's going in there, so all of your commission statements. And then we're also going to go through and find all of your regular expenses. So for a realtor, we're probably looking for cell phones. If the company is paying, maybe a car lease is being paid through the company, anything that is a regular expense to run your company, we're going to take those deposits into the account, then we're going to take all those regular expenses and we're going to subtract them, and we're going to come up with an income. So it's not your personal income, it is actually what your business is doing minus your expenses. Yes.
And now in order to do this method of the minimum of 6 months, does the person have to be incorporated?
No, they don't. So okay. Yeah, so I just use that as an example. So the other thing that we can do is we can use, I use the example of incorporated because if you're incorporated, then you would have a business bank account, which is what we would take those for. But as a realtor, you would have commission statements. So we could go to your your brokerage and ask them for the last 12 months of commission statements, and we can use those. And that's if you're a sole proprietor, right? Because sole proprietor, if you're a sole proprietor, your money's probably going into just your general personal account, which can get really messy trying to find what is what. So if we could just get your commission statements from your brokerage, we can use that. So that's the nice thing. If you are a contractor, so let's say you're in oil and gas and you contract out to a company, we can use your contract. So there's different ways we can do it for sure. It just depends on your exact how you're set up. But basically, like I said, we are going to go through whatever you have for income that we can prove for income, and we're going to basically come up with an income that we can use, which is typically going to be quite a bit higher than you would claim on your personal income, which is going to give us more income to qualify, plus we can do it a whole lot faster. So this is why being self-employed people, why these products are actually fantastic. So it allows you to buy sooner, and it also will usually allow us to get you more mortgage because we're going to use a higher income.
Yeah, and I can attest to that because I am self-employed, and I was able to get $100,000 more in mortgage with an alternative lender than I was with a big bank.
Yeah, for sure.
As a general example.
Yeah, yeah. Almost every time as an alternative lender, it's going to be even though you're going to pay, and I guess you're going to have a little bit higher rate, and you are going to have a fee with an alternative lender. Okay. Once again, we're not talking about private fees and rates. We're talking about in the middle. So good example right now on the prime side, we're right around 4%. We have a alternative lender that's offering 4.69 right now. So you're literally like 0.69 off having a prime mortgage. And realistically, you're probably closer to 0.25 to 0.3 difference between the alternative lender and the prime lenders. And then you have a 1% fee. So it costs you a little bit more with that 1% fee, but you're not having to you're not having to claim a whole bunch of income. So that $100,000 more that Tanya qualified for, she may have had to spend 2 years claiming, maybe $50,000 more income on, for 2 years, which puts her into a different tax bracket, which means she's paying X amount more of income tax. So these guys are allowing you to get through it without having to claim that higher income, without having to wait 2 years. There's so many benefits to it. It's actually like, this is the product for self-employed people for the most part. Okay. So I have a couple of examples for this. So let's talk about a realtor. We did a deal for a realtor last year. The realtor was buying a home with 25% down payment. The personal income taxes for the previous 2 years. So she's been a realtor for years, but she was claiming around $90,000 average for 2 years. What she was looking for, we required quite a bit more income. So we were able to get our commission statement from the brokerage and use 120 grand from the income to qualify. So her commission statements were showing quite a bit more than her personal income taxes, and we were able to use 120 grand, which is what we needed for her to qualify for the mortgage that she needed. So we would not have been able to do that through a prime lender, not even close. Another one that we did not that long ago in 2024 is someone became an independent contractor in June 2024 and was able to buy in August 2025. So basically became self-employed June 2024. We only had, because of the way the tax years work, obviously with personal income tax, we only had a half a year of personal income taxes based on the new contractor position. So we really had no income that we could use for this scenario because we had half a year of personal income taxes as a self-employed person. Because this person was on contract, we were able to get 12 months of bank statements plus the contract, and we were able to use the deposits minus regular expenses to qualify for a $600,000 purchase with 25% down. So not only was she able to qualify for more mortgage because of the income we were able to use, but way, way faster. If she had waited and tried to go through a prime lender, we would have had to wait for this year taxes, and we would have had to wait for 2026 taxes. So she's looking at buying 2 years later than we were able to get this deal done. Okay. Her rate, I'm going to say at the time that we did it was about 0.25. higher than we would have got on the prime side with a 1% fee. So things are happening way faster for these self-employed people. And this is a big reason a lot of the mortgages that we do are for self-employed people for these reasons. Okay. All right. Number 2, bruised or bad credit. So when you are on the prime side, most lenders these days are looking for credit scores of 700 or higher. We can go a little bit lower than that, typically 680, 670, 660 with a really strong deal, and for good reasons why that score is a little bit lower. But to be honest with you, lenders are really looking that 700 is becoming that number that they like to see for people on the A side. 600 is the absolute minimum. So if you have a 600 or below score, we actually cannot legally get you a CMHC insured deal in Canada. So alternative lenders on the other side, they like higher credit scores. But if someone does have bruised credit, I have done, I think the lowest I've done on the alternative side without having to go to private was about a 450 credit score. And that's that, that person had lots and lots of credit issues on their credit. We were still able to get it down below 500. We've done a few under 500. And, because of the lower credit score, they are probably going to be rated a little bit higher risk. So their rate is going to go up a little bit. Their fee is not going to go up. Their fee is the same, but their rate is going to be a little bit higher for the risk. So the lower the score, the bigger the down payment might have to be. So once again, if someone comes to us and they have a 450 credit score and they want to buy a house, that lender might come back to us and say, look, we need 30% down. We just need a little bit more security. This person, we're willing to do it for this person, but we need a little bit more into this house to basically cover themselves in case this person does default on the mortgage. So that can happen. They will look at people with current collections and missed payments. So collections and missed payments can drag your score down considerably. On the A side, if you have some collections or missed payments on your credit bureau in the last 2 years, for the most part, lenders on the A side are going to say, no, we need a clean 2-year history. These guys will look at current collections and missed payments as long as you bring it back up to date before closing. So they'll look at current collections and missed payments. We are able to get people that are 1 day out of consumer proposal or bankruptcy. So if you pay your bankruptcy out today, we can get you a mortgage tomorrow. Once again, you're probably looking at a higher rate. You're probably looking at a bigger down payment. But on the prime side, if you come out of a bankruptcy, you're looking at a minimum of 12 to 24 months before they'll even consider you. And even at that point, if you haven't done everything perfectly, they're going to say no. So we can look at people right out of bankruptcy or consumer proposal. We've also and we're doing one right now, where we are refinancing a person's house. So they currently own the house. They're in a consumer proposal. They have lots of equity in their house. We are actually refinancing them out to pay their consumer proposal out. So we are able to get them back on track by refinancing, paying the consumer proposal back. We're probably setting them up about 6 to 8 months ahead of time. They are going to be able to start to rebuild and get themselves set back up to be a prime borrower again. So this is, once again, along with the self-employed, bruised or bad credit or lower credit scores for whatever reason, we are able to help people out. We typically, and I'm going to say typically, we only do, whenever we're doing alternative lending, a lot of them only offer 1, 2, or 3 year terms. There's a couple that offer 5-year terms, but we kind of look at your scenario. So let's say that we were someone was coming right out of consumer proposal, or we were paying their consumer proposal out. We would probably put them into a 2 or a 3 year, because they need that time to rebuild, get set back up, get to being a prime lender again. And so we're trying to time this mortgage to when they're going to be a prime borrower again, and then we're going to flip them over to the prime side. If someone comes to us and let's say they're just, they just have a lower score right now because maybe they're carrying a lot of debt, and so their credit score has been dragged down. Maybe we only put them into a 1 year, because we're going to put a plan in place with them to try to get them a year from now back on the prime side. Okay, so the terms on these are typically going to be a lot shorter than on the prime side. So examples that we've had. So we got a few more for this on the examples for bad credit. So buyers were a year out from paying off their bankruptcy, which included a foreclosed property. So foreclosed properties in mortgages, especially on the prime side, is like a hard no. If there's a loss, so if a person has a mortgage and they foreclose on a property, lenders on the A side, that's like the worst thing you can do. And lenders are really, really, really hard on people that have a previous foreclosure, especially if there was a loss to an insurer or to the lender. And we have lenders that if you've foreclosed on a property, they will never ever for the rest of your life, they will never give you a mortgage. So having these prime alternative lenders, subprime lenders, allows people who foreclose on a property to get into houses as well. So in this scenario, alternative lender was willing to provide a mortgage with as little as 25% down payment. So not a big down payment. They were able to come up with it. They had the money to do that. They were only a year out from a bankruptcy, which is already an issue with a foreclosure in it. And this lender was willing to give them a mortgage at 25% down. So that's a pretty big deal. That helps these people who prime lenders are going to look down at because they foreclose on a property, and alternative lender steps in, allows them to get into their house, and then we can rebuild their credit, and hopefully in a couple of years we'll be able to find a lender for them that will help on the prime side. So that was a big one. Credit scores in the low 600s, but with multiple current lates. So scores were well below prime lending, and buyer had current late showing. Mortgage was approved with a client just having to get the late accounts up to date. So this is something we do quite often, where once this would be a situation where we just put them into a 1-year term to get them to the point where they've rebuilt their credit, we've got their lates up to date and all that stuff, and we just want to get that 12 months in, and then we're going to flip them over to the prime side. Very recently, I think we're actually working on this one right now, is a refinance to pay out a consumer proposal. So the homeowner has about 20 grand left owing on a consumer proposal. There was enough equity in the home to do a refinance to pay off the proposal. So basically the homeowner can now focus on rebuilding the credit. So now we get them out of the proposal. We're going to put them on the right track to make sure that they're rebuilding their credit the proper way. And then we're going to get them over to the A side, or if they want to buy a different house or get a bigger mortgage, we're going to try to get 12 to 24 months to get them on track. Yes.
Yeah, in terms of looking at options of refinancing, at what point in somebody's mortgage term does it make sense to do that? Does it, I know that there are typically fees involved with that. Do they get rolled into kind of the refinance? Can you maybe speak to that a little bit?
For sure. So every scenario would be very specific to that person. The first question we're always going to have, the first thing that's always going to matter is where they are on their current term. So if you just signed a 5-year term 6 months ago and you're locked into a 5-year fixed and you want to refinance your property, you need to find out, is that penalty going to be $3,000 or is it going to be $15,000 or $20,000? Because that's definitely going to set us on a path of, is the $20,000 penalty going to be worth doing this? Probably not. In my world, doing this for a long time, I always kind of look at a penalty. When we're dealing with hundreds of thousands of dollars, I always kind of look at a penalty of $3,000 as doable, right? $3,000 to get into a lower rate, or maybe to pay off $50,000 of credit cards or something like that. To me, that makes sense. But it really, honestly, is case by case. We have to look at what's the penalty going to be? What are your savings going to be? What are we doing with this refinance? Are you refinancing to buy a car, or are you refinancing because you've come up with a debt is also all of a sudden popped up that you need to get rid of? Financially, you need a little bit of help. You need some money. Do you? There's lots of reasons. And we have to analyze and have a discussion with that client, because our job, in my opinion, is to educate, not make decisions for. So we're going to go through things, we're going to talk about things, and the person has to decide, does this make sense for me to put me in a better situation? I guess is the big one. So
Yeah, and now in terms of the fee, if you were to refinance, that just comes out of what you end up getting in your pocket, I
in most
suppose.
cases, yeah.
Yeah.
In most cases, we'll work any fees, any penalties or anything they have into it. Yeah.
Mm. Cool. Thank you.
Okay. You're welcome. All right, so we'll move into number 3. So this one is a little bit more technical, but basically, being able to get a higher mortgage by using extended ratios or extended ratios. So anytime you do a mortgage, so unless you're dealing with a private lender, because private lenders are not technically don't really have someone that watches them. You have mortgage investment corporations and like true private lenders who set their own rules, set their own guidelines, so they can kind of do whatever they want as long as they are falling within their own guidelines. Any regulated financial institution in Canada, whether you're an alternative lender or a bank or whoever you are, has to show affordability. So every one of them has to have what I have on this first point here. Prime lenders have strict debt to income ratio. So basically, the government tells us how much you can afford. We call them GDS, TDS, debt servicing ratios, that kind of thing. So in general, 39% of your gross monthly income can go towards the household costs, and 44% can go towards all of your debts. So for every $1,000 of household income before taxes, $390 of that maximum can go towards your mortgage payment, your taxes, your heat, your condo fees. Okay, so that's maximum. And then $440 of that $1,000 every month can go towards all of your debts. So if you have a car payment, credit card bills, student loans, anything like that, all of that has to fall under that $448 per $100,000. Okay, where alternative lenders help out on that one is most of them will go to a minimum, and I'm just going to say 50-50. So $500 of every $1,000 can go towards the house. So mortgage payment, taxes, heat, and or everything. So car, any other loans or credit that you have outstanding. So they're increasing that by 11%, which $110 per $1,000 when you're talking about someone making 10 grand per month or whatever it is, household income makes a big difference, huge difference. We have some of them with a little bit bigger down payment. So if you start putting 35% down, we'll actually go up to 60%. This means that people on the low end would qualify, like you were saying earlier, Tanya, that you qualified for $100,000 more mortgage with a B lender or subprime lender. So minimum $100,000, as much as $200,000 more mortgage than you would with a prime lender. So some people will come to us. They are employed. They have excellent income. Everything about them is they're a prime borrower, but they want to buy for more than they can get from a big bank. Or from a regular prime lender. So we can put them through a subprime lender or alternative lender and get them more mortgage. So they're still they're really a prime borrower as far as everything goes, but they just want more mortgage. So we have to go through an alternative lender. This one, I would say we probably use the least out of, being self-employed or bad bruised credit, but this still does happen from time to time where we just need to get those ratios higher. Okay, so someone just really, really wants to buy this house. Maybe they know that they're going to get a raise a year from now, and it's going to be much more affordable, and all these other things. So we can use these extended ratios to get them into a home now that might be more affordable for them down the road. So still a great option for someone who self-employed people. We can still use these extended ratios. People with bad credit, we can still use extended ratios, or prime borrowers, we can use them as well. So I didn't have any examples for this one because, like I said, we don't use it a lot, but that kind of is self-explanatory. So I'll jump into the investors part. So where investors are becoming more alternative lender or borrowers is that most prime lenders now, and I'm not going to say all of them, but most of them now limit your how many homes you can own to 5. So basically, I own a home. let's say I have a vacation property and I have 3 rentals, I am now no longer a prime borrower anymore. So if I want to buy that 6th property, I want to, a small investor, I want to buy that 6th property, I now am going to have to be a alternative borrower. So that's first part of it. Second part of it is how we calculate rental income. So prime lenders have very strict guidelines regarding the use of rental income for qualifying. So once we get, I own my own house, I have 1 rental property and I want to buy a 3rd or 2nd rental property. The way that I can use that rental income from the current rental I have and the new rental I have, prime lenders really scale back and don't make it super easy with that income to qualify for that 3rd property, versus alternative lenders who will loosen that. So alternative lenders, most of them will do up to 10 homes. So they're double the homes. So as a small investor, as soon as I start getting into 6, 7, 8, maybe 10 homes, alternative lending is going to be the way it is. We do have lenders who will go above 10 as well. So 10 is kind of average. They also will use the extended ratios. So we're able to, once again, to go 50-50 or 60-60, what we talked about before. But not only is that helpful, but we can use much more aggressive rental income calculations. So where that prime lender is holding you back from using rental income, these guys are allowing you to really push the limits with rental income, which is going to help you qualify for that next property and that next property and that next property. So alternative lenders are becoming the choice for small investors, because the big banks, the prime lenders, all of those guys are starting to cut you off at 5 and make it really hard to go past that 5. Yes.
Yeah, and I've also read recently that the rules are changing a little bit to make it even more stringent for investors, and I haven't really dug into that or know much about it. But does that differ much from what's up here?
So I know exactly what you're talking about, and honestly, nobody knows what it is.
Oh, okay.
So yeah, so
That's
OSFI,
helpful.
which is so the OSFI, which is the Office of the Superintendent of Financial Institutions, they're basically the government watchdog for financial institutions. So they watch the banks, they watch any financial institution in Canada. OSFI is the boss. They're the ones that make sure that they're following the rules. They make the rules. They basically are the head of all financial institutions in Canada. So OSFI about a month ago, and this is typically, hopefully nobody from OSFI watches this. Typically what happens is OSFI will come up with a new rule, and what happens is they don't really, they might do a little bit of investigating and talk to the lenders, but a lot of times what they'll do is they'll just say, we're making this change. Here's a new rule change that is going to be in place. Then what happens is the banks and the insurers spend time going back and forth, figuring out, okay, what is this? How are we going to do it? Does it work with us? How can we run our business? What do they actually mean by this? The one that they came up with about a month ago was very confusing. I tried to read it myself, and it was not super clear. Basically, what they were saying was that they don't want people buying investment properties to be able to use income on more than one property. So if you used your income, your personal income to buy property number 1,
Right.
you wouldn't be able to use that income to buy property number 2.
Right. Like they have to subtract.
Yeah. So you would actually
balance it out.
Yeah. So it would really, what it would basically do is destroy the small investor, is what it would do. It would make it so that only large corporations with lots of income outside of your personal income, the large income, large portfolios that could support these purchases, it would basically make them the only people that could buy investment properties. Now,
unless they use someone like an alternative lender, because they're not.
No, the alternative lenders will have to follow under it. They are under OSFI. Yeah.
Okay.
The only ones that would be able to do anything would be private lenders. So you'd be able to go through a private lender, but once again, your rate would go up significantly. Your fee goes up significantly.
Yeah, you
Much
might
more
be paying
expensive.
like 10% or.
Yeah. So alternative lenders are governed by OSFI, so they do have to follow the rules.
Oh, okay.
Now, since then, I've talked to two lenders. I've talked, well, three actually, and asked them their interpretation of it, and they said it actually has not been a conversation at all within their company.
Interesting.
So that tells me that the lenders are not concerned about it. So it's either not coming anytime soon,
Gotcha.
or in some cases, OSFI will come out with something, and realistically, the banks are already kind of doing it in a way that they
Right.
figure out, like, because banks already scale back how much income you can use on rental properties,
Mhm.
maybe they're already being compliant and they don't need to change anything.
Right.
Yeah. So my opinion, until the lenders and the insurers come out and say, hey, this is what rule is changing, we
Mhm.
just go on as normal, because a lot of times they're the ones that have to decipher, have to work through and come up with what it actually means.
Gotcha. So potentially right now, people um hyping it up more than it needs to be.
I think so. Yeah. Is it something that definitely um, made you kind of question what's happening? For sure? Because the way it was worded to me, if they were to implement it, it sounds like it. Like I said, it will destroy the small investor.
Right.
Like there will no longer be the ability to, have a person who owns, starts buying and to get two or three small rental properties. I don't think that's going to be a possibility anymore if it goes in place. I could be
Right.
wrong, but that's kind of how I read it.
Mm,
But until our lenders and our insurers get excited about it and start sharing stuff about it,
yeah,
I've learned from all the years I've been in this, I'm not going to get excited until it happens.
that's fair. Yeah. Thanks for clarifying that.
Here, for sure. All right, and I think that is it. Um, I always put this at the end of all of my presentations. This is my mortgage toolbox. It's a great app that you can put on your phone. It's fantastic for doing pre-qualifications, stress test to see what you qualify for, mortgage payments, all that stuff. So I always put this on there. If you want to download it on your phone, please feel free.
Amazing. And we're going to stop recording now. And if anybody else has any questions, we'll be able to ask them. More Ryan's contact info was at the beginning of this presentation, but as always, you can reach out to Urban Haven Group if you want us to put you in contact with Ryan, or go back to the beginning, find Ryan's contact and contact him directly. All right. Thanks.